Welcome, everyone. Pleased to have you here with us today for our 66th, I believe, episode of This is CDR. This is CDR is an online event series presented by OpenAir since, I believe, August of 2021 to explore the range of carbon removal solutions currently being researched, developed, and deployed, and to contextualize them for policy proposals that OpenAir is working to advance at every level of government in the US, and as we'll talk about later, in national and subnational jurisdictions globally. My name's Toby Bryce. I'm based in Brooklyn, New York, and I work on policy and market development with OpenAir. If you haven't done so already, please introduce yourself in the chat, and when you do, direct it to everyone, not just hosts and panelists, so we can hear where you're zooming in from. Quick background on OpenAir, if you're not familiar with us, we're a distributed all-volunteer network dedicated to advancing carbon removal. We're a global community. We work on what we call missions, which are open source projects in the areas of policy, innovation, messaging and communications, and activist market development. Our co-founder, Chris Neidl, is running the chat. Thank you, Chris. And he has put some links in there, some background links about OpenAir, the missions we work on, and also a link to join our group. And here is what it looks like on our website, just as a sample of the missions we're working on. It's really a fun, wide range of projects, and we'd love to have you join us and be a part of what we're doing. Before we get started with the program today, as always, we're going to define our terms. This is a definition of carbon removal from the CDR primer, which is a great resource to learn about carbon removal. It's essentially also the same definition that the IPCC uses. Carbon removal is purposeful human activity to remove CO2 from the atmosphere and durably store it in geological, terrestrial, or ocean reservoirs or in long-lived products. Two quick points to call out when we talk about carbon removal. Number one, it's to disambiguate it from quote-unquote carbon capture, or CCS, which refers to capturing CO2 from an emission stream like a cement plant, a fossil carbon emission stream. This may or may not be a good climate solution depending on the techno-economic and socioeconomic circumstance, but one thing it's definitely not is carbon removal, which is again removing CO2 from the atmosphere. Number two, when we talk about carbon removal, it's really critical to call out clearly upfront as many times as possible so everyone hears that carbon removal is in no way, shape, or form any sort of substitute for reducing emissions. We need to reduce emissions and decarbonize the global economy as quickly and as completely as possible. And I would go further to add that carbon removal, which is really important, has no meaning if we do not reduce emissions. We have to reduce emissions by like 90% plus. That said, there's clear scientific consensus, including most recently in very stark terms in the IPCC AR6 synthesis report, that carbon removal will be required at gigaton scale by mid-century to balance out the 10%, 5% of emissions that are hard to abate, the residual emissions, to get to net zero. Beyond that, in the second half of the century, we have 1 trillion plus tons of anthropogenic CO2 we've put in the atmosphere. And so we're going to need to start removing some of that so we can restore our climate to a safer and healthier state. So reduce emissions, but we also are going to need to build a carbon removal capability. We're currently at kiloton scale. We're removing 50 to 100,000 tons of carbon removal via long duration. Carbon via long duration carbon removal, and we need to scale that to gigatons. So that's many orders of magnitude to traverse over the next 2 decades. And so that's the work that we're doing, and that's what we're here to talk about today. I'm going to pass it over to my colleague, Megha Raghavan, who is going to talk a little bit about run of show and then introduce today's speaker.
Hi, everyone. I'm Megha Raghavan. I am an OpenAir member based in London, and I work on policy and market development as well. So as usual, some quick housekeeping notes. We're going to start with a quick presentation, followed by a few prepared questions, and then moderated audience Q&A. So please type any questions you have for Natalia into Zoom's Q&A box as we go along, and just make sure you find the one that is for Q&A as opposed to the chat, because it helps us to organize the questions a little bit more easily. We will be recording the event, so we'll send the video link out to all of you who registered, and we'll also post it to OpenAir's website and OpenAir's YouTube channel. This week on This is CDR, we're very pleased to welcome Kita co-founder and CEO Natalia Dorfman to discuss how insurance can help facilitate and accelerate the scaling of CDR. Natalia is the CEO and co-founder of Kita, which is the carbon insurance specialist. Kita's purpose is accelerating investment in high-quality carbon removal projects with insurance products that reduce transaction risk and safeguard the performance of carbon purchases. Kita's flagship insurance product is called Carbon Purchase Protection Cover, protecting buyers of forward-purchased carbon removal credits against under-delivery. Prior to founding Kita, Natalia spent 15 years as a business development and strategy specialist within the legal sector, including leading the climate risk practice strategy as global head of new business at Clyde Co LLP. Her experience with large corporations on their climate change-related challenges has inspired her to help accelerate positive change through entrepreneurship. She was named among the top 100 female entrepreneurs to watch by NatWest and the Telegraph in November 2022. So Natalia, whenever you're ready, on to you.
Great, thank you so much. That was a very kind introduction. And thank you to everyone for listening today. I'm very pleased to be here. Let me just share my screen and then we'll get going. So, like Megha just said, I'm CEO and co-founder of Kita. And Kita's purpose is using insurance to be an enabling force to unlock financing to scale high-quality carbon removal projects. So today what I'm going to speak to you about is really three things. So one is how insurance does that, how it can be an enabler for unlocking that finance. Second will be Kita's insurance product, the carbon purchase protection cover. And then third will be further risks in the market that I think are insurable, sort of a product roadmap for us and for other insurance companies out there. And then of course, questions. So first, as always, let me see if I can make my computer function. There we go. So I will say, since we started Kita, probably the number one question I've gotten is, why did you start a carbon insurance company? And so often when I start presentations, I start with why carbon removal. The lovely thing about this audience is I do not need to do that. So let's go straight to why insurance. I think probably all of you know insurance to some extent. You probably have car insurance or home insurance. And so you probably know that insurance is basically a contract. You have a risk. You pay me today to handle that specific risk. And if that risk happens, let's say a fire, I will pay you back in line with the terms of our contract. When insurance works, great. It very much is an underpinning of the global economy. When it doesn't work, I think this quote here says it all: the world doesn't function without insurance. And I know that sounds kind of dramatic, but it actually very much is true. And I remember the exact moment when I realized how true that was. Like Megha mentioned, I was at Clyde Co, the world's largest insurance law firm, for about 8.5 years. And I started there in May 2013. And when you do business development and strategy for a large global law firm, it's very key, obviously, that you understand the industry that you're working with. So a Clyde Co partner took me actually to where I am today, Lloyd's of London. It's the largest insurance marketplace in the world. And he took me here to learn about insurance, the sophisticated business insurance. And it is where it struck me just how much is insured and how essential it is, from political risk cover to protect against, for example, expropriation of assets, to natural catastrophe risks to cover the billions and trillions of property all around the world, to cyber and data protection risk for these intangible assets that are increasingly so central to our lives. You can literally insure anything. A sommelier's knows you can insure. And that is because every business out there that's looking to capitalize on opportunity also has inherent risk as part of that opportunity. And insurance is key to managing that risk. And so, for example, this quote, which is actually a very great podcast, Desert Island Discs, Amanda Blanc was referencing, during the global financial crisis, there was an insurance company that insured the majority of the world's aircraft. And during the financial crisis, it was called into question as to whether or not this insurance company could continue to function. And the fear was quite evident. If those aircraft do not have insurance, they do not fly, right? The bus does not leave the station. Nothing functions without insurance. So, why insurance part 2? And I promise it is part 2 of 2. It's carbon removal, right? We all know we need to be removing gigatons of carbon from the atmosphere. We all know that will require trillions of dollars in investment. And hopefully I have just convinced you that nothing works without insurance. And this is a market that, broadly speaking, does not have insurance. And so let's look at this from 2 parts. One, how is insurance essential to unlock those trillions of dollars in financing? And second, how is insurance actually hugely powerful in helping to lay a path forward for how to scale this market? First, let's look at the former. How does it unlock that financing? And I think at a high level, it helps to unlock financing by freeing up or making more efficient your balance sheet. So let's look at this at a sort of simple example. My family has bikes, as you can imagine. We try and cycle places. I have 2 young daughters and a husband. My daughters treat their bikes terribly, right? A complete disregard for property. They leave them in the playground, they leave them in the garden, they sort of chuck them down when they're done with them. But I don't insure my daughters' bikes, because if their bikes are damaged or stolen or lost, that doesn't impact my balance sheet, my family budget. I can easily replace them on Facebook Marketplace or what have you. It's very affordable, not a problem. My husband's bike, on the other hand, is this sort of fancy bells and whistles racing bike. And he treats it really well, but we do insure that. And that is because if we lost that bike, the amount it would cost me to replace it would damage my balance sheet. Let's call it 5K. I don't know how much it costs, but let's call it 5K. I don't want to have to pay 5K out of my monthly budget. And I don't want to hold 5K back on my family balance sheet on the off chance that we're going to need to replace this bike. I would much rather pay a small amount to insurance companies so they hold that risk for me. And that frees up my 5K to go and spend on other things. And insurance for this type of trillions of dollars in financing is really no different. When you insure the financing of these transactions, you can free up that money on your balance sheet. You can cycle more money back into more projects. We can increase the scaling of carbon removal. The flip side is then how does insurance enable a path forward? And I think this is a way that people don't think about insurance, but it can be really hugely powerful in new markets via outlining what is insurable. So what data do we need? What contractual structures are easiest? What kind of MRV is going to be required? And doing this in collaboration with market participants, but we can help outline the risk framework that people need to follow. You almost think about it as like steps on a path. If the path is already paved for you, you can run. If you're out there, you have to be hacking through the woods. It's going to take you a lot longer. Insurance is part of paving that path. And so then that comes to Kita. One of the challenges with insurance is almost a chicken and egg challenge. You need insurance to scale new markets, but new markets are inherently very difficult to insure. They're almost by definition new, they're small, they're risky, and there's not a lot of historical data that insurance companies like to use to pull pricing analysis so they can price their insurance policies. And so with Kita, when we started, we saw this huge gap in the carbon markets and carbon removal specifically, where there just wasn't available insurance. And we started to see this as a sort of ceiling to growth for all of these amazing companies out there. And so we thought we can create a specialist carbon insurance company that really understands this market, understands the players within it, and we can build out a portfolio of insurance that helps these companies scale. And so that is exactly what we're trying to do. And we don't do it alone. We very much think of ourselves as a bridge builder between carbon markets, carbon removal, and insurance. We like to build partnerships between the two. And we ourselves have a lot of partnerships on the insurance side. And later, when I talk about our first insurance product, I'll talk about one of the reasons why people would buy it, which is to protect against counterparty risk. And so you might be thinking, well, actually, what about my counterparty risk with Kita, a young insurance company? And so this slide is in essence explaining how we mitigate that. We're something called a cover holder at Lloyd's. So coming back to Lloyd's of London, the world's largest insurance marketplace, we're actually a company within that Lloyd's of London umbrella. And how it works is that we develop and we sell our insurance policies. You're very much getting a Kita insurance policy, but we don't hold the regulated capital that pays our claims. So instead, we are actually backed by Chaucer, Munich Re, and Renaissance Re, and then further backstopped by Lloyd's, such as that these are the companies that pay our claims. These companies have very high credit rating, A+ rating, and so as such, our insurance is a A+ rated insurance policy, and that's why we can insure projects for out to 10 years. I think, again, going back to unlocking financing, this also is really important because if you finance a carbon removal project and you insure it via an insurance company that has a high credit rating, all of a sudden it becomes a credit-worthy transaction and you open up your ability to finance it in different ways. I'm happy to come back to that in the questions, but I think it's a very core point in terms of how we're structured. And so now let's start getting into actually why Kita did our first insurance product, carbon purchase protection cover. And I know I'm preaching to the choir with this slide. Removals matter. All of you knew that. All of you know the shortage of supply right now. All of you know that we need upfront financing to get these projects off the ground. And all of you know that that comes with risk. And of course, risk can be managed with insurance. And so that was really the problem that we were trying to solve for, that supply problem. How do we get more carbon removal companies off the ground and scaling as soon as we possibly can? And so carbon purchase protection cover is geared for the buyer, or call them financier, who's putting money up front into a carbon removal project, and we're protecting them against the risk that they don't receive a verified carbon credit. So very much a delivery risk project or product. High level, how it works is trying to align how the carbon standards and methodologies work. And so obviously a CDR project itself goes from its development through to its validation and then ongoing verification. The carbon buyer is dividing its carbon strategy and how it's going to engage in this market. And then we're looking for those who are going to be pre-purchasing those credits. At that point is when they would also buy insurance. At the point of delivery, if they receive their carbon that they expected, there's no insurance claim and the insurance policy could potentially roll over to the next vintage. If they have an under delivery or non-delivery, that's where the insurance would kick in. So in terms of KETA's role here, I would say actually this assessment phase has increasingly gotten more important. When we started, we thought we would really just come in sort of at the point people are buying the carbon, they would want the insurance. But we increasingly see people really want to speak to us earlier on in their buying journey. And we often also hear from the CDR project developers themselves in terms of could we do a sort of risk assessment on them to identify, I suppose, almost their insurability, and if there's any ways they could manage their risk more effectively to make them more insurable as a selling point to those buyers. But at a high level, again, we would provide the insurance once a project has hit that validation phase. Prior to that, we might be able to do a commitment policy. But broadly, the insurance would come in at validation phase. We can insure out to 10 years, and of course, we would monitor the project along the life. And then if there's an under delivery at the verification, that's when a claim could occur. And so what we cover, like I said, the projects covered are pre-purchase agreements. We do not insure pure pay on delivery. I can get into this again in the questions, but pure pay on delivery, there's been no money down up front. You just secured your supply of carbon. It's a harder thing for us to insure because there's no insurable interest. You haven't put anything into the project. So it has to have some form of money up front. The policy cover, if any of you are familiar with insurance, it looks most like a credit insurance policy. So it would be an under delivery or non-delivery of your carbon that can't be made good via the terms of your carbon contract. So for example, let's say your carbon contract has a pre-agreed delay period. You're allowed to have a 6 months delay, let's say. We would follow the terms of your carbon contract before paying out a claim. So we're a backstop to the carbon contract. The policy timeframe, we can insure up to 10 years. And then the loss trigger is that verification report from agreed third-party verifier. We need that to reduce conflicts of interest. It's not us who says there's a claim. It's not our client, and it's not the seller of carbon. We need to have a third-party verifier to state that there's been an under delivery. So based on that kind of high-level point that we are a backstop to the carbon contract. So it's an under delivery that can't be made good via the terms of the contract. We can cover almost any reason for why there's an under delivery or non-delivery of your carbon. So, but I tend to bucket it into these categories. So one is your avoidable loss event. And I say avoidable is that it's probably it's the fault of someone, broadly speaking, the project developer. So they might have gone insolvent. So I say is a very valid risk, particularly over these kind of, some of these policies, 6-7 year kind of delivery timeframes. It is a risk. They could abandon the project. They could be fraudulent. They could be negligent. Any of these things could result in an under delivery of carbon to the end buyer. You could have your unavoidable loss events. This could just be underperformance, particularly with nature-based carbon removal. Sometimes you just don't know why. Maybe the trees just didn't grow as expected. There's no one reason, but they didn't grow as expected. They didn't capture as much carbon as you thought. You, of course, could have your natural catastrophes, your fires, storms, etc., or a broader type of force majeure event. And then you have your kind of carbon risk. And so this would be the carbon standard itself being invalidated, the methodology changing, or the project being canceled. All of these are valid reasons for why there could be a claim on our policy. The key exclusion right now, for me, I think the key exclusion is Article 6 or political risk. We don't cover political risk generally, but really the key thing that matters is we don't cover Article 6 risk, the nationalization of the carbon by the host country. I'll come on to that when I talk about other risks and other insurance policies, but that's excluded from carbon purchase protection cover. And so just to wrap up on this flagship policy that we have, I really do think of it as enabling an early mover advantage with less early mover risk. I suppose I don't exactly know who's on the call, but when we speak to people looking at engaging in the carbon markets, but really specifically looking at engaging in forward purchasing of carbon removal credits, these are the people who get it. You know, they know they need to lock in supply. They might want to lock in price, but they understand the importance of looking at carbon removal and building up that portfolio. But a lot of them just do not or are unable to, within the structures of their company, take on that upfront risk. And I always like to think of it as risk itself isn't bad, but risk that can't be managed well is bad. And there will be many large companies that have structures within their organization as to how they manage risk. They need to get these deals past finance, past procurement, past risk, and our insurance can help them to put it into a structure that makes sense, such as that they can get more budget and they can manage that balance sheet more effectively, and ideally more money flows into these high quality carbon projects that need to scale. But delivery risk, of course, is not the only risk that we're talking about in the carbon markets. It's a key risk, but is by no means the only risk. And we are by no means the only insurance company out there. The insurance industry is definitely starting to look at this space more proactively, which I think is a great thing. I think it's definitely a market that needs education as to how insurance can help, and where we need to all work together to understand exactly what form of insurance will be the insurance that becomes the real driver of market growth. How much things should be covered and what the right price point is. I think we're early in all of that. But these are some of the buckets of risk that we think about. So project-based resilience is your core insurance, right? When something goes wrong for a business, insurance is there to pick up the pieces and build that resilience. So this could be anything from an unexpected business interruption that say you lose access to your renewable energy, you can't function. You could protect against that. It could be a natural catastrophe that damages your business. It could be, there's a myriad number of things here, depending on the type of CDR project we're talking about. But it's resilience for the project developer to build back when things go wrong. You have your political risk type protection. And like I mentioned already, Article 6, I think, is a huge theme that probably all of us are seeing really slowing down investment into certain types of projects. And it's certainly one of the things that when we speak to buyers, they mention almost always as one of the key risks that's holding them back. Clearly, this is a risk that's moving. And as such, it's a very difficult risk to insure, but it is one that we are working on very actively right now. And so I'd be happy to get people's perspectives into the risk that they would like to have covered here. But it's a product that we would like to get out this year, but we're still to some extent debating whether or not it's really insurable right now. And then finally, the sort of permanence reversal risk. I think this is a core one as well. I was speaking to someone the other day and they said, how is that different from project-based resilience? And I think it depends on who the buyer of that insurance is. If it's the project developer looking for their own reversal risk, then it falls into their resilience category. You know, they've had a loss and they're going to need to fix that reversal to make it good. But likewise, you have buyers of carbon credits who are looking for protection against their own permanence or reversal risk, such as that if they buy and retire a carbon credit and then they become aware that it has reversed, they would like compensation to ensure they're able to repurchase an equivalent credit, such as that they can be secure in their net zero strategy. So these are some of the risks that we look at, and I say the political risk and the reversal risk are very high on our development timeframes, but we also do speak to the project developers a lot around the resilience risk they would like covered. And so last slide, this is just our team. We have team members who span carbon, law, climate science, carbon accounting, financial products, risk management, data science. And I say we are a very friendly team and we do quite legitimately like trying to help this market. So don't hesitate to get in touch. And with that, I will take questions. So thank you very much.
Thank you, Natalia. That was a really fantastic presentation and answered many of my questions personally. So, and I hope the audience appreciated it as well. Just want to start, we often start with asking folks about how they got into this position that you're currently in, your journey to get to insurance and carbon removal. And I'm going to put a link in the chat. You and Naeem Merchant, friend of Open Air, had a great discussion a few months ago on Naeem's Carbon Curve podcast where I heard this story, but if you don't mind, it would be great to hear you talk about that a little bit so everyone can hear where you're coming from a little bit.
Yeah, of course. And I was just asked, do you want me to stop sharing the slides?
Sure.
Yeah, okay. So yeah, my journey to get here. So I grew up in Southern California, which I think is relevant in that I was a sort of outdoor beach kid. I always structured my life, I still do. How can I be outside as much as I possibly can? That led me to majoring in environmental science at university in North Carolina because I thought I could go hiking. I hiked less than I thought. I spent a lot of time in labs. And I also decided I couldn't be an environmental scientist for my job. And so I ended up falling into the career of doing business development and strategy for large global law firms. And I did that in New York, Brussels, and London. And that's what led me to Clyde Co, which I referenced at the start. So Clyde Co, the world's largest insurance-focused law firm, is where I learned insurance and where I became a huge insurance advocate. Over the 8.5 years that I was there, I was promoted up to global head of new business. And I remember I'd come back from my second maternity leave and I'd been promoted while I was on maternity leave. And so I came back and they said, you know, what kind of new business do you think we should be going after? And I remember I said, well, it has to be climate change. Like there has to be so much legal work for us in climate change. That has to be the number one focus. And so I got back into climate change in a professional sense. And that is where I guess, again, like once you learn with everyone here, right? Once you know what you know the science, you know the challenges, you know the speed in which we need to change. I think I had a moment where I either thought I can ignore this and let other people deal with it and just go on with my life, or I can try and do something myself. And like, who knows what that thing will be, but it feels like I need to try to do something myself. And so that's the route that I chose. My job at Clyde Co was pretty broad. And so I decided I would have to leave to be able to devote my career to climate change. I was looking at a range of ways to do that, including trying to get a job at a large corporate, which is very hard to get hired as a sort of sustainability person as a large corporate. But, you know, I was looking into what I could do. And that's when I came across Carbon 13, which Megha now is in, actually, so overlaps there. But Carbon 13 is a venture builder for climate tech startups led out of Cambridge in the UK. And the ethos of Carbon 13 is to build companies that can both be financially successful, but really more importantly, drive a real impact in terms of removing carbon from the atmosphere. And so that really kind of hit home for me. And when I was accepted into Carbon 13, I thought there's a huge opportunity to do that. Startups have a real potential to work at speed and figure out problems faster than large corporates. And then it was at Carbon 13 where all these people were looking at building these amazing companies, some of them carbon removal, some of them not. But it really did strike me. I was that boring person asking everyone, like, cool idea, but how are you going to get insurance for this? And if you can't get insurance, once you get past your grant funding and your VC funding, how are you going to get the money for your business? And that's when, working with Paul and Tom, my co-founders, you know, we really started to think about insurance could be a real solution and we could build an insurance company. And so that's where that came from. And then, I mean, the iteration from then to now obviously has been a journey with a lot of education along the way. But it was really just the recognition, without insurance, this market isn't scaling. I'm convinced of that. It just doesn't scale.
Yeah. Yeah, no, I think your presentation made that very clear too. And how long has it been since? And Chris and I will put a link to Carbon 13 in the chat, which is a really amazing program. And if you're thinking about starting a carbon removal company, you should definitely look into it. But so from graduation of from Carbon 13, or from company formation, like how long ago was that to where you are now?
Yeah, of course. So Carbon 13, I'll just take you a bit before company formation. So we started Carbon 13, we were cohort 2. We started in September 21. Carbon-13 splits into 3 kind of cycles. The first 6 weeks are finding your co-founder. It's a bit like a terrible like dating reality show mixed with some kind of like you're fired type, whatever that show is. It's quite stressful. Of like 80 people, you need to go out and speak to everyone and figure out who I could actually start a business with. And at the end of 6 weeks, you need to be agreed that you and I are going to build a business together. And if you don't have that partnership, you leave the Carbon-13 program. After that, and so that's where I met Paul and Tom. Then after that 6 weeks, you had, I think, around 8 weeks to put together a business pitch. And then you pitch that to Carbon-13 for investment. And then at the end of that, you had the end of it until the end pitch to a bunch of investors. And so for us, it was in that phase 2 that we incorporated Kita. We started in September 21. We incorporated Kita on December 21, the 5th of December 2021. And we got our investment from Carbon-13 in January 2022. And so we have, I think, moved basically as quickly as a young insurance company can move, because there's a lot of regulation, but we were always very, very focused on exactly what we wanted to do and what we wanted to be. And we always had the time frame in mind if we needed to launch our first product, January 23. And we did hit that, which is great.
I mean, that's amazing. And it's, I think, a testament to you and your team, but 18 months, I mean, from financing and effective company formation, and you really are kind of the leading name in the carbon insurance space. So congratulations. And well done. Wanted to ask, so to me, it was, as a non-insurance person, when I think about it, it's not super clear where insurance should live in the CDR sector. I thought it was interesting that your first product is to be purchased by the buyer of a carbon credit. Can you talk about how you arrived at that decision? And do you think that all insurance will rest at that point, or are there various points in the ecosystem and value chain that will need to be insured? Maybe talk about that a little bit. I think it would be helpful for me at least, to understand that a little better.
Yeah, of course. And there's a few aspects to this question, so let me try and break it down. So the first I'll touch on is just why we decided to insure the buyers first. And then the second is, I think, the kind of end state ecosystem and where insurance sits in that. So on the first question, we actually started out wanting to insure the developers, especially coming out of Carbon-13. I think that's where sort of like my heart was. I wanted to help the developers scale. The reason we then ended up going to insure the buyers is 3 top line reasons. So one is realistic, just regulatory requirements. So becoming an insurance company is hard. You need to be regulated to sell insurance per jurisdiction. So in certain jurisdictions are much harder than others. And so when you look at where carbon project developers are located, some of them are in jurisdictions that are pretty hard to insure, to have the license to insure a company in that jurisdiction. So we have actually done exceptionally well because we're a Lloyd's cover holder. We benefit from the regulatory sort of auspices of Lloyd's. So we are allowed to insure companies via their UK or US entities, and we're expanding to Canada. After that, it will probably be Singapore, Switzerland, Europe.
Got it.
But it takes time. And so we did have just a realistic view of, where are some of these project developers located, and some of them are going to be in countries it'll take us ages. So that was one. Second was, again, we're backed by Chaucer, Munich Re, and Renaissance Re, and we needed to get that backing from those larger insurance companies in order to sell insurance. And again, in a new insurance market that's high risk, there's comfort and there's safety in insuring corporates rather than startups, SMEs, and individuals. And part of that is because of complaints. When you sell insurance, you have to comply with a lot of regulation, and one of them is fairness to customers. You need to make sure your buyers understand the insurance policy so that they understand what they're being covered for. And broadly speaking, when you're selling a sophisticated insurance product like carbon insurance, it's not necessarily the easiest thing to understand. There is potential for a lot more complaints, broadly speaking, when you sell to SMEs and some micro businesses. And again, there's more regulatory restrictions on it. And so very much the preference of the insurance backers was we started with corporates who tend to be more sophisticated buyers. They have in-house insurance buying teams. And then I guess the final point does come back more to something that spoke to me was it is a new market. Insurance in any new market is not yet at a kind of agreed price point that's commoditized. It's broadly speaking going to be a slightly more expensive insurance product. And when you're selling to the developers, they're already pretty margin constrained, broadly speaking. And I guess I thought the only reason you as a developer buy insurance is if you can claw back the cost of that insurance via selling a higher value carbon credit. But in a new market, that's not yet proven. Like, we don't really know if people will pay more for an insured credit or not. Like, you think probably they would, but you're not really, it's not like a proven point. And so I sort of thought, actually, it makes sense to almost test this with corporate buyers, with the big buyers, and see if it starts to take off and become more of the norm. Like, it is just an expected part of your transaction. And at that point, then all of a sudden selling to the project developer has a proven track that we know you can pay. You will get a higher price for this credit. And so that was our thought process in terms of pivoting with the first product to be for the buyers. And also, to be fair, now that we've been speaking to buyers for quite a while, I really do think that insurance will help unlock some of the financing, right? They need to fit the risk frameworks within their companies, and insurance is part of that. So then the second part of the question, in terms of what's the kind of end state of the carbon markets or insurance in the carbon markets, I don't have a crystal ball, but I broadly speaking think everyone needs insurance. But I think the majority of the insurance will end up lying with the project developers. I tend to think of it, I think the way the actual credits of the market are structured could end up looking more like a bond market. But in terms of how the actual kind of projects are run, I think it looks a bit more like a commodities market. So you do have like companies that actually do the doing, right? These are the project developers that are capturing the carbon. And they have all myriad sorts of risks, from their operational risk, their supply chain risk, their liability risk. And probably the big liability risk is the reversal risk. I think the liability in that future end state will lie with the project developers. If they release it, they need to fix it. Whereas right now, that liability is, who does it sit with? Then you'll have the buyers of the carbon who still will want protection, just like in the commodities market. You still will want protection for what you're purchasing, particularly if you're forward purchasing it, which you might have. And then you have the financial markets that spring up around it, which have their own specific risks and will buy in up with their own specific insurance coverages. So I really do think there's actually a wide range of insurance. And the way that we tend to look at it now is insurance that fits the contractual structure. So insurance for a forward purchase is different than insurance for a long-term pay on delivery offtake. And then that fits the specific risk, like an Article 6 type risk.
Got it. That's very helpful and very good answer. And it does, the more you think about it, the opportunity before insurance in this category seems very large and important for scaling, as you've pointed out. I have a bunch more questions, but we have also a large volume of audience questions. So I'm just going to ask one more and then switch over to Megha to start asking some audience questions. So it's pretty clear that to get to gigaton scale, the public sector is going to have to play a role in carbon removal. And there are kind of two forms for that, I think. Procurement, like direct procurement of carbon removal, so being a buyer in some form, and then also setting up compliance markets, which are obviously different. And OpenAir is really focused on policy, and we work on, among other things, state level policies in the US. And we have two really interesting examples of both of those policies here in the US. In Massachusetts, there's a state level direct procurement bill that basically gets the state of Massachusetts to start buying carbon removal like Frontier or like an incumbent buyer in the voluntary market. And then there's another really novel bill in California called the California Carbon Dioxide Removal Market Development Act, which is setting up an early stage compliance market in California. Polluter pays to start getting polluters to buy negative emissions as offsets of their hard to abate emissions. And can you talk about how insurance can play in both of those scenarios? How different would it be from the way you're working currently with the voluntary market with your first product, and any kind of key differences you see in terms of when the public sector gets more involved in the market?
Yeah, I mean, that's a great question. So I'd say at a high level, I don't really think of our insurance as a voluntary market insurance product. I think of it as an insurance product for a specific type of purchasing contract, which is obviously a forward purchase. Obviously, that purchasing contract currently exists in the voluntary market, but if it were to translate into a compliance type market, it's more about the contract than the market. And so as such, I would say for those types of mechanisms that you're talking about, you know, insurance can still very much play a part. It just depends. I think with all things, when there's a contract, it's where the risk is and what that risk is. Like, so where is it? Who's holding it? And then what is it? So in a government-driven sort of a compliance market, generally the price risk is less. So you might not need to insure like you might in the voluntary market, your kind of price hedge type financial, you know, sort of derivative product. But still the risk is still sitting with someone. So you might still have the project developer will still almost certainly have a reversal risk. So they still might need that. The buyer will still probably have some form of risk that isn't managed well by the contracts. So I know this is kind of a fuzzy answer, but I think insurance would still fit well into those markets, but it depends on how that purchase is being done and who's holding the risk. And going back to my kind of bike analogy, you know, if that risk is big enough for them that they want to pass it off to a third party, that's where insurance would come in. And insurance has been in the compliance markets. For example, in the California compliance market, Parhelion has had an invalidation type insurance policy for years. And so
Okay.
you might start looking at, and I'm pretty sure there's a insurance product as well in China that looks at sort of an under deliver for the project developer. So I think you could look at analogies. I think insurance would exist, whether it would be a forward purchase, probably, you know, questionable. Depends on the contract.
Yeah, got it. Very helpful. So we have a bunch of questions, and please, if you have any questions, put them in the Zoom Q&A box. And Megha, if you're ready, you want to hop on and start marshaling some of these questions.
Yeah,
22
sure.
questions. I'm feeling scared.
Don't worry, I'm going to combine some of them. And I won't unfortunately get to all of them most likely, but I will do my best. So I think the first one, which quite a few people asked aspects of this. So where do you guys sit in the ecosystem with respect to like who does the MRV, who quantifies technical risk, project level risk, like how much of this does Kita take on? And then where do you sort of rely on third parties?
Yeah, that's a great question. Like I said, we're a very partnership driven organization. And so broadly speaking, if we don't think we do it better than somebody else, then we will partner with somebody else to do it. So we have built a risk model that relies on various inputs, and some of those inputs we'll take from other people. So we'll work with the ratings agencies. Their inputs provide a useful framing for the kind of high level quality of a project, which doesn't inherently relate to under delivery of a project, but does give us a sense as to, you know, could this project be canceled? What's the likelihood of a sort of methodology change, that type of thing. We work with third-party MRV providers 100%, and we need third-party auditors in order to assess whether or not there's been an under-delivery or not. And then throughout the life of our insurance, both at the outset as sort of an additional initial check, and then throughout the life of the policy, we work with, you know, sort of satellite data LiDAR type provider. I know that's not the right terminology. I'm very much not in charge of this part of the business, but we work with those types of organizations that help us to do ongoing monitoring of the project. And so, yes, very much partnership driven. You know, I don't see the point in reinventing what other companies are doing well,
Right.
just for the sake of it being us doing it. I think we all need to move fast, and that, broadly speaking, involves working with other people.
Okay. And like, how does the sort of value chain look there? Are the MRV providers and the people you talked about, are they suppliers to you and then you sort of sell on a package from there, or how does that work?
No, so they would be potential suppliers to us. If we need their data as an input to do a risk model, sometimes we would. Sometimes we might buy their data as an add-on to sort of do an additional sense check. But that would be incorporated, broadly speaking, into the cost of the insurance product that's then sold on to the end buyer.
Got it. Okay. And just thinking about costs. So when, I know there's a lot of different costs out there when you look at the numbers for what CDR is being sold at, but, thinking about a future where we get to $100 a ton or something around there, how much do you see insurance being a component of that cost?
That's a good question. Let me just, I guess, pick that apart because it's a hard question to answer.
Yeah,
So,
totally.
Broadly speaking, insurance, no matter the type of insurance, is a percentage of the total sum insured. So let's say I buy 10 carbon credits at £10 each. I've just spent £100 on carbon. Insurance will then be a percentage of that. It might be 1% of that, or all of a sudden I'm paying 101 total and it's an insured purchase. It might be 10%, whatever it is. So it is a percentage of the total value of what you have purchased, or the total value of your risk.
Right.
Then how much the insurance costs will very much depend on what is being insured and the type of project. So you can look at analogies in other markets. A political risk cover will obviously be a different price than a just pure delivery risk. And so thus, at a high level generalization, it is very hard to say. I would say one point that we would note for insurance in this market is that you have to think about what it's competing with, and how people are currently handling the risk today. Because the risks aren't new. It's not like all of a sudden some new risk has entered the market and insurance is the savior of that, of everyone. The risks have been there. Everyone is handling them in one way or another. Broadly speaking, I would say people are handling them in contractual arrangements, pushing the risk to whoever has the least power in that particular transaction. And people often seem to manage that risk via either overbuying. So I need 100 credits, I'm going to buy 200 credits, or holding back a buffer. And so thus you can start to compare the cost of insurance to the actual how you're self-insuring right now. You're either holding back some credits, or maybe you're over purchasing. Is insurance more cost effective than that? Or does insurance enable you to get better terms of financing?
Yeah, got it. I mean, I think, that's an interesting point, right? Like I think thinking about, riskier potential deployments and being able to put them on kind of equal footing with less risky deployments based on just using insurance. I think a related question that someone asked is like, does KETA actually set standards and enforce kind of standards for permanence and durability and those kinds of things for projects that they're willing to insure? Or like, what's your kind of take on how you want to influence that in the market, if any?
Yeah, that's a good question too. I guess one thing that we definitely have no interest in being is a standard.
Yeah.
We are not competing with the standards in any way, shape, or form. What we would love is there to be very strong agreed standards, because insurance works best. It's much easier to fit insurance into a well-structured market than to try and build insurance into something that's kind of moving as you go along. So no, we would prefer to work with the standards and help them to strengthen. I think where we are in the market is a market that's obviously still moving in terms of what those standards are and what the expectations upon them are. So I think insurance has the potential to just come in and just say, if you want the insurance industry, or at least this insurance company, to insure this project, we're going to need this type of data, right? We're going to need this type of MRV. We would like the audits to be done at this type of frequency. This type of contract is hard. You can just give guidance. We're not trying to set our own standards. We do, of course, have our own risk models and our own assessments of what we can and can't insure, but that would be different than another insurance company. So it's not like a KETA standard. It would be more KETA trying to help guide the standards in terms of what we would find insurable, and then people can take that or leave that as they wish.
Right. Okay, cool. A couple of people asked about the Article 6 point you mentioned. So could you just unpack that a little bit and talk about, what policy changes might help improve that sort of risk or deal with that kind of risk going forward?
Yes. So again, we're not trying to influence Article 6. I think the risk right now that is holding back investment is just that there's a lot of uncertainty, right? Uncertainty is a destroyer of financing. People just don't like. So right now you have all of this uncertainty, and broadly speaking, the uncertainty, at least that we hear voiced, is what happens, and this is actually a direct quote, what happens, I wanted to give 8 million to this project in this country. What happens if the day after I give them 8 million, that government just says, thank you very much. We're taking your 8 million and we're keeping your carbon. Like, what happens in that instance? What is my protection? That is the kind of concern we hear voiced a lot. And it is a kind of concern that the political risk insurance market has dealt with. So with oil assets, right? Like, that is a risk. You can have an oil asset in a country somewhere in the world where that government can say, thank you very much, it's mine now. It's a risk that people have been managing via insurance for decades. And so what we try and look at is, what are the analogies there in terms of the expropriation risk, the export license cancellation risk, that nationalization risk. The nuance here with Article 6 is that it's not finalized yet. And so if you have a legally binding contract, let's say you have a letter of authorization from a host country, and then that letter of authorization is revoked. Now, all of a sudden, I have something I can insure. I have a legally binding contract, and I can insure. There is a letter of authorization, yes, and the risk is that it's revoked. That revocation of that letter of authorization is going to have some kind of impact on the buyer and the seller. We're not going to stipulate what that is, but we know that it will have a financial consequence, and as such, we will compensate you for that loss. And now, because you have insurance protection, you can invest or sell with more confidence. But when you're at a point in time when those letters of authorization don't exist, or where countries are still in flux in terms of determining how they're going to treat Article 6 and their NDCs, it is just a very challenging sort of moving feast to insure. And so that's what we're trying to come out right now, is sort of, is it insurable now? It definitely will be insurable in the future, just is it insurable now?
Got it.
If anyone wants to talk through that in more detail, do get in touch. We have a little survey that we like people to take, because it helps us to identify what actually the key risk of all the many sort of Article 6 political risks out there. Like, what is the real thing you need covered?
Is that just on your website or something? People want to.
So we can send it around though if anyone wants it.
Cool. Okay, I'm just going to do a few more before we go. So have you spoken to Frontier or other offtake buyers, and what is their view on how this fits in with existing provisions and offtake agreements and the way they've structured it?
Yeah, of course. I'm not gonna speak to Frontier specifically, just because I'll just go more widely. Yeah. I think broadly speaking, again, you tend to fall into two categories. You have long-term offtake pay on delivery contracts, and we do not insure those. Nothing wrong with them. We just don't insure them because no money has been put down up front. So there's no insurable interest for us to insure. So the entities that are forward financing or forward purchasing via long-term offtake pure pay on delivery, we don't do that right now. So thus we're looking at those that are looking at some form of upfront investment, whether it's pure equity investment or getting some kind of line of credit to do an investment. Those are more the companies that we look at. Very much sometimes those are building out a portfolio of carbon assets and looking at for insurance to wrap the portfolio. But the point you make about contracts is really interesting. We speak with people about contracts a lot, both because since our insurance is a backstop to the carbon contract, we're quite specific around the types of clauses we would like to see in a contract. And then also it's an introduction of insurance into a market that has, broadly speaking, been managing risk via contracts. And so what I would suggest, if anyone out there is buying carbon, having a conversation early with an insurance company to understand how insurance can fit into your portfolio of purchases, because there might be potential to tweak your contracts in ways that might be beneficial to you now because insurance is available. So for example, force majeure, a lot of contracts we've seen have a walk-away clause in the instance of a force majeure event. Everyone just walks away, no liabilities. If an insurance company is willing to cover a force majeure event, you no longer necessarily need a walk-away clause. Things like that. There's potential for shifts in terms of some of the contractual structures. No, not necessitated, just potential for.
Yeah. Okay, last one before I let you go. Where do you kind of see the future of your product portfolio going as the market develops and as Kita develops?
Yeah, I mean, we very much are focused on having a portfolio of products. I see expanding delivery risk to cover more types of carbon removal techniques. I see political risk. I see reversal risk. I think these are probably high on our roadmap. And then we would like to ensure we protect some of the project developers out there. So I think that is a key point. But I do, at a high level, I think everybody has risks, and key to specialization is really understanding the financing structures, more so than pure operational kind of, risk. I think other insurance companies might be better at, like, my machinery broke type insurance. But in terms of how do these carbon projects get financed and what are the risks inherent in those financing structures, I think that's where we shine. And that's where we would like to develop a real portfolio to enable more financing.
Great. Thank you so much. This has been amazing. And sorry I did not get to nearly all the questions, but hopefully covered enough of them. And back to you, Toby.
Thank you
very much.
Good job, Megha. And Natalia, that was amazing. Thank you so much for being with us. So we appreciate your time, and I think everyone learned a lot today. So thank you for joining us.
Thank you very much for having me. Pleasure.
Our pleasure. I'm going to share my screen again briefly and just walk through a couple of programming notes that we have coming up. We actually have quite a bit, and I'm not going to try to pronounce this, but tomorrow, when my screen loads, we have a webinar about carbon removal happening, policy and the opportunity for carbon removal in Germany. Please, I think Chris will put links to the Eventbrite for this in the chat. Please join us. Got a great group together to talk about this. Thursday, we have two events. The first is early in the morning, East Coast time, midday European time. I can pronounce this one, Remoción de Carbono in España. And it's a similar conversation in Spanish about the CDR opportunity in Spain. So separate Eventbrite for that. Please sign up and join us if you're interested. And then finally, we're going to have Megha back on screen Thursday, moderating a discussion with our good friend Sebastian Manhart, who is the lead policy advisor for Carbon Future, which is a leading European carbon removal marketplace. And Sebastian will be telling us what's going on with carbon removal policy in Europe. And just spoiler alert, there is a lot. So a lot of really important developments there, and Megha is going to be talking to him about those. And then finally, we have a pretty cool lineup of This Is CDRs coming up in May and June. Next week, we have Nikki Batchelor from X Prize, who will update us on what's going on with the prize, the September final deadline for applying, how they're going to be winnowing the 1,000+ companies down to a kind of a working group for the final sprint of X Prize, and also some recent reports that they've issued from the ground up, which is in a really fantastic environmental justice report, an equitable deployment of CDR report, and also the circular carbon network, which is kind of a snapshot of the carbon management industry. So looking forward to having Nikki on next week. And I believe we'll put a link in the chat to the This Is CDR Eventbrite page where you can sign up for all of the other programs that are coming up. So thank you to everyone for being with us. Thank you again to Natalia for such a great and informative presentation. Everyone be well, and we will see you again soon.